Hi, my name is Joseph-Antoine Magdalani. Today I am with Kareem Zakir, our portfolio manager. Welcome to our quarterly capsule. So today, Kareem, we will talk about three topics. The first one, I would like you to discuss a little bit about a market review, what happened during the past 3 months and what do you expect over the next 3 months. Second point will be to discuss about taxation because we are in the tax period right now. And the last point will be to discuss briefly and give you more information about this new first home saving account. Could be very interesting to put in place. We're going to give you some info about that. So the floor is yours.
Thank you, Joseph. Hi, everyone, and welcome. So I'm very pleased that the first 3 months of this year has been much better for all the portfolios. Our most conservative portfolio has actually done 5% net of fees for the first 3 months of the year, all the way up to the growth portfolio that's doing a little over or thereabout 7.5% for the first 3 months of the year. So markets have rebounded.
Feels good.
Feels good.
Yeah.
2022 was not fun. We mustn't forget that 2019, 2020, and 2021 were fantastic years, and 2022 was really gut-wrencher for everyone. Just to recap quickly, October 2022, the interest rate on the 10-year U.S. Treasury hit almost just about its peak at around 4.25%. And that's the benchmark that we use, by the way. And the stock market simultaneously hit its bottom at the same period of time. Since then, inflation was 8.1% in 2022. Just recently, StatsCan came out with the inflation rate at 4.3%.
Very good.
And they're forecasting 3.5% in Canada for the summer.
So we saw an impact, Kareem, of increasing the interest rate over the inflation, right?
Yeah, and their goal is to continue dropping to 3% by the end of the year and 2% by the end of 2024. So what's happening? Since interest rates have started to come down because of inflation, stocks are starting to react positively. And we hit maximum pessimism around October 2022, which means that everybody who wanted to sell just about sold out. Now the buyers are starting to come back in. So let's move on to the tax side.
Great. So taxation. 4 small points that we would like to discuss. The first one is that we recommend all of our clients to wait until the first week of April before filling up their taxes.
So a lot of people don't realize that we hold trusts in the portfolios. For instance, we own a health care trust, which consists of about 60 healthcare companies. Well, these packages don't have to issue their T-slips until the end of March. And so by law, the trusts in Canada can wait till the end of March to issue their T-slips. Most do it during the month of March, and then by the time April comes around, they come out. So please do not rush to do your taxes. All you're going to end up doing is having to redo them if you get amendments or you get new T-slips at the end of the year. I know accountants want to get them done as soon as possible, and I can understand why. I can relate to that. My suggestion, please wait till the first week of April to file your income tax.
Great. Second point would be to have a small discussion over the split of an income at the age of 65. So it's something that you should consider having the discussion with your accountant or with us during a financial planning, is to split your income at the age of 65. It could be with a RIF or a pension plan. That way you can reduce up to 50% of the revenue that you can split with your spouse. And it could have a very nice impact over taxation.
Yeah, it lowers your income tax.
Absolutely.
A lot of people don't use it, and your accountant is the best qualified individual to know the exact amount that should be allocated to your spouse to get the maximum benefit.
Right.
So maybe you want to mention it to your accountant to make sure that they test it out. Most accountants do it anyway, but that doesn't hurt to ask.
Great. Life insurance. I think we don't speak as much as we should about life insurance. And the reason why I say that, it's because sometimes clients accumulated very big amounts inside of register accounts as of RIF or RRSP. And if there's no spouse and someone is passing away, well, the 50% or almost 50% of that amount will go to the taxes.
Exactly. So let's take an example. Somebody accumulates $500,000 in their RIF, and they don't have a spouse for whatever reason. When they pass, that $500,000 goes to the estate and gets fully taxed. So one of the best tax strategies would be to take a life insurance policy in order to cover that $250,000 of tax that will be paid to the government. It could be important to certain people and less important to others. We just want to talk about it. It could be advantageous to you. It's a lot less expensive to pay a life insurance premium over even 20 years
than having to pay $250,000
in one shot. So it depends on you. The key here is to have the good enough health to qualify for the insurance policy.
Great. Flow-through shares.
Yes.
I know it seems a little bit complicated, and we might have to sit down with you to give you more info about that, but it's something that you should consider if you're having an annual income of $200,000 and more.
Exactly. So other than, once you maximize your RSPs and you do your TFSAs, if you have an income of over $200,000, or if you sell a property where you make a big profit that year, flow-through shares could be advantageous because a contribution into a flow-through share can save you up to 65%. The biggest advantage of all this is that in Quebec in particular, when you invest in a flow-through share that qualifies in Quebec, when you come to sell it the following year or two, okay, that capital gain in Quebec is not subject to tax, at least most of it. It is subject to tax on the federal side, but not on the provincial side. So the advantage is really, really interesting. It's quite complex. There's a lot of risk to flow-through shares. Flow-through shares are basically an investment in mining companies. It could be lithium, metals, gas, whatever they invest in. You can buy a package of flow-through shares through a fund. If you feel that this could be something that is worth it for you, again, don't hesitate. Give us a call. That's what we're here for. We're your financial advisors. We're here to help you maximize your revenues and minimize your tax hit. So let's touch base on the FHSA, the First Homeowners Savings Account, which is new.
So first of all, let me put it this way. It's a mix of a TFSA and a RRSP, because all of your contribution inside of the FHSA are tax deductible. All the revenue that you're going to generate inside of that account are tax-free, and you can put up to $40,000 inside of a FHSA. How can you put the $40,000? It's $8,000 annually for a maximum of $40,000.
So basically, you could put $8,000 a year for 5 years. You get a full tax deduction on the $8,000.
Right.
And when you come to withdraw it, you have to buy a home with it.
You have to buy a home.
Tax-free at the withdrawal. What if I decide I don't want to buy a house?
Well, there's two possibilities. The first possibility would be to withdraw that amount, and the withdrawal will have to be added to your annual income, so you'll have to pay taxes on that. Or if you want, you can roll it over into a RRSP.
Yeah, if you have the room.
If you have the room. Also, a very important point is that compared to doing a wrap, once you do the purchase of your property, you don't have to reimburse the $40,000.
Yeah, like the wrap.
That's the main difference between this and a wrap. So yeah.
So basically, a wrap, you can withdraw $35,000 from your RSP account. You can add the $40,000 if you've got the means to do so. That's $75,000 that you could put towards a down payment on a property, but you have to pay back the wrap 1/15 per year of the $35,000.
Exactly.
And if you're a couple, that could be up to $150,000 down payment on your first home. So this is a great plan for possibly your children. Many young people don't have this kind of money lying around, And a lot of parents want to help out their children. It's a great way to help your children start off in life investing. So if you're interested in looking at that, again, don't hesitate, reach out. So on that note, thank you, Joseph, for that information. And if anybody wants to consider developing a financial analysis or financial plan, give us a call. We're your advisors. And on that note, I want to wish you a great spring. We'll see you in the summer. Bye.
Thank you.